Hello everyone, welcome back to another interview we have as part of the Greenwich Economic Forum. I'm joined by Pierre Breber, the Chief Financial Officer of Chevron. Pierre, nice to have you with me. Thanks for joining us.
Thanks,
Pierre, let me start because last week or earlier this month there was a big announcement from Chevron about its energy transition plans, and I think it'd be good to start there before going into the bigger picture on other things within Chevron as well. And so let me ask straight off the top, what motivated Chevron to come out with this statement about its energy transition plans now? They involved a $10 billion commitment to new low-carbon energy solutions and to decarbonizing parts of the business. That's a trebling of what you previously committed. What was behind this announcement? What was behind doing it now? Is it because of shareholder pressure? Is it because of societal pressure or a change in government in Washington?
We announced, as you said, a tripling of our capital. Our previous guidance in total capital lower carbon businesses, $10 billion. We announced growth targets on renewable fuels, hydrogen, carbon capture, and offsets, sectors of the economy that are hard to abate, that cannot be easily electrified, and that leverage our capabilities, assets, and customer relationships. So yes, it was in response to our customers, airlines who want sustainable aviation fuel, retailers who want to lower the carbon intensity of the fuels that they run in their trucking fleets, retailers like Walmart and Amazon, and yes, investors who want to know how we're going to sustain higher returns in a lower carbon future. Our message is pretty simple. The winning combination, we think, for investors is a high return, low carbon traditional business that delivers the energy that's in high demand today and very likely for many years to come, coupled with a faster growing new energy business that delivers lower carbon solutions to our customers.
And why now? Is it something that's changed in the company because of shareholder pressure? Is it something that's changed in society? As I said, is it because the signals from the federal government, the Biden government, are obviously much more aggressive on the climate file?
We've been working energy transition for several years, and during our Investor Day in March, we announced that later this year in the fall, we would do a deeper dive on energy transition. So it's something that has been in the works for a while. We're making real progress, and the pace is accelerating. We announced in the weeks leading up to our energy transition spotlight a joint venture with Bunge to increase the production of renewable fuel stocks. We entered into one of the world's largest green hydrogen projects in Utah called ACES that'll deliver low carbon power and transportation fuels to California. We took the lead on engineering and design on a carbon capture project in California. So this is something that we had long planned, and we talked about our March Investor Day. It evolved from a number of years of work and really progress that is really accelerating as we're seeing more and more actions in the space.
One of the things Chevron didn't announce was a net zero commitment, and some of your rivals or peers in Europe have announced a commitment to net zero emissions. Why has Chevron not gone down that route yet?
We showed a pathway to net zero, and we have line of sight to more than 50% reductions in upstream carbon intensity. And we said the balance will require new technologies, new innovations, more ambitious government policy, and the development of large offset markets. These are all areas that we're working. We formed a new group called Chevron New Energies just in July, and they'll be working in that space. And we also said that we're working on an updated climate report, which we'll publish next month, that will be responsive to recent shareholder votes on both net zero and on Scope 3 emissions.
And that shareholder vote that you're referring to was the shareholders backing at the AGM in May for a resolution demanding that Chevron cut its Scope 3 emissions, i.e. those from the products, the emissions from the products it sells. Are we to understand from what you just said that Chevron will be committing to cutting Scope 3 or committing to a net zero target? It's just that you're waiting to announce it in October or whenever?
Well, I'm not going to get ahead of our updated climate report. We've long reported our Scope 3 emissions for many, many years. We support a price on carbon as the best policy for society to reduce Scope 3 emissions at the lowest cost to society. And the actions that we announced a couple of weeks ago to grow renewable fuels, hydrogen, carbon capture, they reduce Scope 1 through 3 emissions by 30 million tons per year. That's equivalent to about 18% of the annual emissions from the state of New York. So the actions we're taking do abate, either avoid or abate greenhouse gas emissions in a fairly significant way as we think of Scope 1 through 3. So again, more to come next month when we issue our updated climate report.
And does Chevron think that reducing Scope 3 emissions or societal ambitions to achieve net zero can be achieved at the same time as increasing oil and gas production?
Well, oil and gas production will follow oil and gas demand. As you know, it's been increasing for many, many years. It decreased with COVID. We'll see where it goes. We're seeing demand really recover pretty strongly while we're still not out of this pandemic. Gasoline demand is back to pre-COVID levels. Diesel has been there for a long time because shipment of goods continued through the pandemic. Petrochemicals has been very strong as we've seen increased demand for those products. And then domestic air travel, so jet fuel to domestic air travel, that recovered in countries once vaccines came out or there was pretty good control of the virus. The missing piece on demand is really tied to international travel. International travel is cumbersome and restricted right now. Hopefully, as vaccines roll out further across the globe, we'll see increased international travel, and then we'll see a full demand recovery.
So Chevron itself, though, can grow its oil and gas production over the coming years at the same time as it tries to reduce its emissions.
We're 2% of the overall market. And so, yes, we think the most responsible companies, we're among the most financially strong, the greatest, some of the best technical capabilities, operate at very high ESG standards, that when you're 2% of the market, whether that market continues to grow modestly, plateaus, or even decreases modestly, there is room for a company like Chevron to grow in that on the traditional side, whether it's organically or inorganically, as we did last year when we acquired Noble Energy.
Part of this announcement that Chevron made earlier this month around lower carbon business lines and so on was about, as you say, aviation fuels and so on. One thing that you didn't commit to and haven't at all committed to really is kind of businesses that BP and other super majors have, which is renewable power, wind and solar. Can you explain why Chevron doesn't want to get into that business? And if it doesn't see wind and power as viable businesses, what are the future low-carbon technologies that you do see making a return of the kind that might compete with oil and gas?
We will purchase wind and solar to lower the carbon intensity of our operations as we are in the Permian Basin. We'll purchase wind and solar, low-cost wind and solar, to enable green hydrogen, as I mentioned, for the project called ACES in Utah that'll supply California. We don't think it's in the interest of our shareholders to invest capital to produce and generate wind and solar because it's pretty mature. We know what the returns are, and we don't have competitive advantage in it. So the areas of lower carbon solutions that we're focused on, renewable fuels, hydrogen, carbon capture, and offsets, these are areas that leverage our strengths, our capabilities, our assets, our customer relationships. So let me give you some examples. In capabilities, carbon capture will require an understanding of subsurface technology. We're a leader in understanding how to store gases in the ground. Assets, we showed how we could convert our refineries, part of our refineries, to have the capability to run 100,000 barrels a day of renewable fuels that would meet all of our U.S. jet airline customers with a 5% sustainable aviation fuel blend. And then in terms of customers, as I mentioned earlier, our customers are seeking out lower carbon solutions for the hard-to-abate sectors. There's a lot going on to decarbonize the grid. We also need to take actions to decarbonize air travel, heavy-duty transport, industrial applications. And so customers, as I mentioned earlier, are looking for companies like Chevron to provide those solutions.
But clearly oil and gas remains the core competency in the future for Chevron. BP calls itself an energy super major now. Total has just changed its name to Total Energies. Do you consider yourself one of the last remaining true oil super majors?
We're an energy company, and we're a materials company. Our petrochemicals, again, go into all kinds of products that we use every day. We'll be an energy company that'll deliver traditional energy, oil and gas and propane and other fuels that are in high demand today and expected to be in high demand well into the future. And we'll do that with lower and lower carbon over time. And we'll deliver new energies, again, renewable fuels, renewable natural gas, renewable diesel, sustainable aviation fuel, hydrogen, carbon capture and offsets. That'll be an increasing part of the future. We think that winning combination for our investors is a traditional business that is high return, low carbon, combined with these fast-growing new energy businesses.
Yeah, let me ask you about the performance of the company's stock prices and in fact the performance of oil equities in general, because the oil price has surged over the past several months as the economies have recovered from or reopened following the harsher lockdowns last year, and thanks to OPEC's cuts and so on. But the equity prices of oil companies have not recovered to the same extent. Why do you think it is that there is now this disconnect between the commodity price, which is roaring ahead, and the share prices of oil and gas producers? You would have thought, and I think in the past there was a pretty clear link between the two, and you would have thought that in this recovery, oil and shareholders, investors would reward the producers of a commodity that is rising so quickly at the moment.
Chevron trades at a dividend yield of about 5.5%, and that's in a U.S. market with an average dividend yield of 1.5%. So 3 or 4 times the dividend yield, and that's higher than it has been historically, and that reflects that underperformance, as you say. I think that's plain to see. So the actions that we're taking, and our message to investors is very simple: deliver higher returns, lower carbon. In terms of higher returns, we've talked about delivering return on capital employed that's more than 10% at $60 Brent, generating more than $25 billion of excess cash. That's cash in excess of our capital investments and our dividends, and delivering lower carbon. So 35% lower carbon intensity by 2028, this tripling of capital investments to new energy businesses, and enabling that 30 million tons of carbon reductions that I talked about before. So yes, investors have questions. We're trying to answer them. We think that combination of higher returns, lower carbon will earn a higher valuation for our company, and will show investors that we can sustain higher returns in a lower carbon future.
So, I mean, you don't see this as, because there's been a lot of, as you've alluded to, there's been a lot of discontent with the performance of oil and gas producers in the past because of the way they've used capital. You think the share price at the moment reflects that view of investors, or that the view that investors have of those companies and the performance in the past, not the terminal value of oil and gas producers in general? You don't think there's some kind of bigger discontent with the sector that's brewing in the investor group?
I think it's both. I think, again, we have to deliver higher returns and sustain those higher returns in a lower carbon future. And so, yes, it's not enough to just be a profitable traditional energy business. We need to be a higher return traditional business, lower carbon, and then we need to be part of the solution, delivering the lower carbon solutions that our customers want and that I think our investors are going to value. Our new energy businesses, back to your wind and solar question, we expect them to earn double-digit returns. These are competitive with our investments in traditional energy. These are hard to figure out. There'll be a lot of partnerships, but the examples that I shared, the Bunge joint venture, the entry into the ACES project, we're seeing the deal pipeline increase. We set ambitious targets. If you compare our targets to some of our European peers, if you back out wind and solar and look at targets on renewable fuels, hydrogen, carbon capture, and look at total capital invested into those, we compare very favorably. In many cases, are more ambitious than them. So this is an ambitious program to show, again, that we can sustain higher returns in a lower carbon future. And I think it addresses both parts of your question and your thesis on why the sector has been underperforming.
Are you worried, Pierre, that the investor focus on environment, social, and governance, ESG metrics, the enthusiasm for investors to back clean energy technology is keeping too much capital out of the oil and gas sector? And given that what you say, the world will need more of these fossil fuels in the short term at least, are you worried that those concerns that investors have on Wall Street right now are straining or keeping too much capital away from operators like Chevron or others?
Well, we're generating excess cash right now. We talked about $25 billion of excess cash over the next 5 years. So we're paying down debt, and we don't need to access the debt markets. When we did access and issue bonds last year, we had access to lots of low-cost debt. We've talked about on the equity side, clearly the sector has underperformed. Again, we're trading at a dividend yield 3 or 4 times what the market average is. And so it's up to us to earn a higher valuation by showing that we can sustain higher returns in a lower carbon future. We have very high ESG standards. We engage regularly with our shareholders. Our message and our goal of higher returns, lower carbon, is in part in response to shareholder feedback. There's more work to do to deliver on both, but 10% return on capital employed, $25 billion of excess cash, 35% lower carbon intensity, $10 billion into new energy businesses. We think that's the winning combination to earn a higher valuation.
If you look at the sector at large, do you think there's too little investment right now in upstream oil and gas? Partly because of the concerns of investors, but also because of these commitments that producers have made to lower capital expenditures, higher returns, lower production, less spending on drilling and so on. Do you worry that this is kind of sowing the seeds of another damaging price spike?
There's a chance of that. That's not our base case. We think there is adequate supplies out there at reasonable cost. And of course, OPEC Plus has several million barrels curtailed currently. What I'll say, though, as you point out, there's a lot of constraints potentially on the supply side, and demand is strong. And we talked about demand is fully recovered from pre-COVID levels, and there's another leg that I expect will recover when international travel resumes, international air travel resumes. So we expect prices to moderate as the market works and as supply is added over time.
Chevron has been one of the companies that has told investors we are not going to go back to the heady days, maybe characterized by other companies, who knows, but of spending lots on drilling, a drilling frenzy in the Permian Basin where Chevron has a big position, for example. But at $75 Brent or $70 WTI, don't those commodity prices allow you to be disciplined in terms of paying down debt and paying shareholders adequately and so on, as well as returning to a kind of growth mode that would meet these rising demand, this rising demand that you also foresee? In other words, isn't now the time for a company like Chevron with a strong balance sheet, with this premium position in the world's biggest oil field, the Permian in Texas and New Mexico, isn't it time for Chevron to revert to a kind of oil supply growth mode?
We are going to be disciplined with our capital. We've shown that over the last several years. Also, we're going to look to the market fundamentals. So although the price of crude oil is high, as we've talked about, demand hasn't fully recovered, and OPEC Plus has millions of barrels currently curtailed. The last thing I'll say, and you pointed this out too, there is a disconnect between the commodity price signal and the equity price signal, and we're going to look to both. And there's no signal from the equity markets to increase capital.
And when you look at your portfolio, when you do appreciate that you want to stress the capital discipline and so on, but when the opportunities for growth do arise in the future, when the market sends the signals that you described that you'll need in order to return to some kind of growth, what are the priorities? You have this premium position in the Permian Basin. You have a big gas position, you increased with the purchase of Noble. You have a big position in the Caucasus or in Kazakhstan. You have a huge LNG portfolio and so on. So where are the pillars of the next growth strategy when you do revert to growth?
Well, our cash flow is growing with the capital program we have currently. We've given 5-year capital guidance. It's in a fairly narrow range of $15 to $17 billion between now and 2025. But you hit the big ones. We've been investing throughout the downturn in a big project in Kazakhstan. That'll come on in the next couple of years, and that'll generate growing cash flows. And in the Permian Basin, we're free cash flow positive this year strongly, more than $3 billion. We showed that on an earnings call. And when the market needs the barrels, we can grow that, as I said earlier, from 600,000 barrels a day to 1 million barrels a day. And then there's other shale and tight positions that we have, the DJ Basin, which was acquired from Noble. We also have positions in the Duvernay in Canada and then the Vaca Muerta in Argentina. So we have plenty of investments to pick from, but we'll be very disciplined in how we invest that. And we're focused not on growing production, but on growing cash flow to sustain and grow a dividend. We've increased our dividend for 34 consecutive years. Our dividend is 12% higher now than it was pre-COVID in a sector where most of the companies have cut the dividend and no company has come close to increasing the dividend like we have. And we've been buying back shares for 14 out of the past 18 years. So we have a track record of returning cash and more cash to our shareholders over time. And we have the investment program going forward that can sustain that into the future.
We have time for just a couple more very quick questions. Let me ask about the portfolio again. Are you happy with what you've got now, or do you think there's some gaps that Chevron needs to fill still, maybe on the low carbon side or leaning into more natural gas or a recovery in natural gas demand or rise in demand for LNG? Do you feel the portfolio is adequate for the way you see the market developing over the next few years?
Yes, we like our portfolio. We talked about some of the key assets. The Permian Basin is a world-class asset, both in terms of the returns that can be generated from it, but also its carbon intensity. Mid-teens kilogram per barrel of oil equivalent, that's a leading carbon intensity metric. We have opportunities in the Gulf of Mexico that also have single-digit carbon intensity. So I think our traditional portfolio is advantaged and well-positioned. Noble Energy added to that. We talked briefly about, you talked about the Eastern Med position, the DJ Basin in Colorado. And yes, I expect we'll add more on new energies. We've seen a lot of progress in just the last 6 months. Big announcements with a joint venture with Bunge, the ag company, entering the ACES hydrogen project, advancing a project Mendota that abates greenhouse gas emissions from agricultural waste. So I expect to see progress on both, but we're very well positioned.
And last question just about the sector in general, and especially oil and gas, and perhaps especially in the US. A lot of people have said the shale sector in particular still needs to consolidate to drive more efficiencies. There are too many players. Do you think that, and there has been quite a good deal of consolidation, including and maybe led by Chevron's acquisition of Noble Energy last year. So do you think that consolidation is still yet to play out, or do you think it's pretty much done, or how do you view that, the M&A landscape there?
We started it last July when we announced Noble and others followed. What looked like a good deal then only looks better now. We expect consolidation to continue. Whether we participate or not will depend on if we find something that's as attractive as Noble Energy was. But consolidation tends to happen when prices are low. And again, we started it in last July when oil prices were in the low 40s. We're now seeing oil prices in the high 70s. That makes it more of a seller's market than a buyer's market. But we know that commodities have price cycles, and we'll be patient. And we think over time we'll see this industry consolidate into fewer, stronger players.
Pierre Breber, Chief Financial Officer of Chevron. Thank you very much.
Thank you, Derek.